Get started now. We have enough people. Welcome back, Ashok, where we missed you. All right. So here we're going to go over the calendar. Right now we're right in the middle of earnings season. Earnings season basically just started now, and we're starting out with the banks. So J.P. Morgan started out the earnings season today. Now we're going through a lot of the banks. And Wells Fargo and J.P. Morgan, they actually reported better earnings than expected. We are super overbought in the stock market now. So I'm expecting like some consolidation. If you look at our chart here, just we can see that there are higher highs and higher lows. Right now we're at the super peak of stochastics. If we look at our chart, we're at the top of the channel, absolute top, and we're at 90 in stochastics. So we're super overbought. Everyone on TV says it, and everyone knows that. So I'm expecting some kind of consolidation if we're going to stay in this channel, and that's going to be like at least 5% to get us back down to here. So you have to expect that kind of thing. And let's look at what our meeting notes. We have, we're going to have earnings coming out in the next week, and based on whether the earnings are good or bad, that'll basically help the market. But right now we're overbought, so regardless, we're probably going to be consolidating for next week until the Fed meeting. We have a July 26th Fed meeting that's coming up, and it's expected that the Fed will raise maybe one more time, probably not. We had inflation read came out, I think it was on Wednesday or Thursday, that was showing inflation is cooling off to like a 3% level. So that was really good. The stock market rallied on that. So it looks like we're very near the end of the Fed raising rate cycle. And that's usually good for tech stocks and stocks that are highly sensitive to interest rates. So, but July we know is one of the best months of the year. Let's look at our right there, 79, average of 0.79%. The only months that are better are the end of the year and April and May. So let's look at some of our talking points. We had I think it was the PCI report that came out showing that slower inflation and personal inflation is decelerating. So that was really good. That was one of our catalysts for the market to go up. If inflation is getting better, that's a very good indication that there's a catalyst of the market going up. We also have an amazing 85% of the S&P above 50-day moving average, 69% of the S&P above the 200-day moving average. So it's getting more robust of a rally right now, but we're still overbought. So it's not a good time to buy or start dollar costing in the positions. So what else do we have to have here? U.S. dollar is actually weakening a lot. So that's really good for tech stocks that do business overseas. Because when the dollar is repatriated from overseas sales, that gives a tailwind for the profits for American companies. Now, you see. Let's look at, we already talked about this. Review the major variables in the stock market. Oil is up 10% since the last week, and that is a lot. And usually that's an indication that either there's a supply that's being restricted, or that there's a strong demand and the economy is doing better. And we had this report, the PCI report that came out, that basically said that the inflation is going down, And so we also had the interest rates go down with that, because if the inflation goes down, interest rates usually goes down with that, and then the Fed is forced to not raise rates. So that is very important. The dollar index was 103 last week. It's down 3%. That is a lot for a week. So that's going to give a lot of support to the multinational companies like Google, Microsoft, Apple, companies who do business overseas. And let me see. Gold is basically unchanged since last week. There's no real catalyst for someone to chase the gold right now. Let's look at the fear greed index. We've been at extreme greed for a couple weeks now, and it's basically the same as last week. It's at 80. So people are still in rally mode, and they're not fearful. And there's a lot of momentum in the stock market right now, but we're like at a peak of momentum in the stochastics. If we look at our S&P, we're at the top of our channel, and we're at the top of our stochastics, and people are really excited. That's the exact time when the traders start selling and the long-term buyers stop buying and or sell some. All right, so we saw this U.S. dollar index where it's in a downward trend, and it's continuing its downward trend. So that's really good for the multinational companies, and it's good for commodities too. So as the U.S. dollar goes down, the price of commodities go up. That's because most commodities are priced in terms of dollars. All right, so let me see. VIX is basically the same as it was last week, and it's basically at a low, meaning there's no fear in the market. And this is basically the time. Hold on a second. I'm gonna undo that. Okay, so right now there's no fear. It's a bull market kind of reading in the VIX. So people are not buying puts; they're buying calls instead, and that's kind of where the VIX is right now. So we're in our investor value, our sentiment chart. We're at the very top, the pinnacle of the bull market. We're in a mania stage where everyone's bullish and everyone is very greedy, and no one's thinking about the valuations of stocks. So this is the time when most investors want to start buying because everything's going up and it'll continue to go up. It is only then when you start, as a long-term investor, you have to realize that the fear and capitulation is right around the corner. So just when we see August, September are some of the worst months, so maybe a couple more weeks here, we have positive momentum, and then there's a very good chance we're going to be going down. So you have to be ready for that. I'm ready to hold my stocks through all that. Now, there's it's an interesting article I saw in Barron's. Well, I only saw the title and then the first sentence. I get to pay to get the rest of it. So I thought, well, it'd be very interesting to figure out if this is correct and if we can prove it to ourselves. Visa and MasterCard are strangely undervalued. Both stocks are a buy. So I was expecting from this that we'd see like PEG ratios under 1. And in both cases, Visa and MasterCard are super pricey. They trade at a premium. But what they're saying in this article from the first sentence is they're, compared to past valuations, they're inexpensive. So I thought it'd be interesting to go through this exercise of seeing, why, Visa and MasterCard are trading at where they're at right now. So what I did was I looked at Visa first. And right now I looked at their earnings estimates for the future. You can see when I bought this stock when it IPO'd, and I held it even though, it was kind of tough. But I've noticed that there's a very consistent you don't see many stocks with a very consistent upward trend of earnings estimates and earnings reports. And you have a very consistent 13% growth rate through the next couple of years. And for some reason, 2025 to 26 is 7%, but right now we have a 13% pretty consistent growth rate. And I was looking at this is CFRA report. It's saying its fair valuation is 241, and it's undervalued by 5%, according to CFRA. And whenever we look at this, yet both stocks look cheap relative to past valuations. The one way to look at that is to look at the past years. These are the last 10 years of the PE ratio. I got this from the CFRA report on Merrill Edge, and you can see the PE ratio high, low for the past 10 years, and you can see that it basically averaged like at a high, maybe 20, 29, and at a low, multiple is around 21. And so they're currently trading at 24. So that's why they said it's at like a historical low for the stock. It's trading at a low PE. It's not that low, but it's to the lower end of this range. So if it's trading right now at 24 PE, it's at the low end of every year's range for the past 10 years. So, and the reason why it's it demands such a premium is you can see that it is steadily growing, in a straight line. You have 11, 12, 13 billion, 15 billion, 18. You can see it's growing like at 10% consistently, and the earnings projections are consistent. And that's probably because of their business model, where they have a moat. They're based on the money they make is not based on liabilities like people defaulting on their credit cards. They just charge a transaction for every toll. They charge a toll for every transaction through their system. So what I did was they have a PE of 24, and they're growing at 13%. So they have a PEG ratio of around 1.8. So that means their fair value really is around half of what they're trading for now. But because they have such a strong growth history, they trade at a premium to other stocks because they're consistently growing at 13%. That's Visa. So that was a good exercise to go through. Let's look at another. Let's look at some more information about Visa. We have profit margins 50%. That's like 4 times our 10 minimum, and return on equity is 42. That's our minimum is like 13. So both of those are really good, and they have this kind of matches our PEG ratio, where we had 1.8 and Yahoo Finance says 1.5, and they have very little debt too. So that is pretty much why Visa is still trading at a premium. I think it would trade better if it didn't have some of the regulatory problems, like they're talking about splitting up their business so that other companies can get a chance and they won't have monopolies anymore. But if that happens, we don't know what the margins will be after that. Let's look at MasterCard just for fun. This is CFRA's take on the fair value of it. They said it's overvalued by 15%. We're going to look at that same revenue. You can see that it'll trade for a premium because this is going up in a straight line also. The revenue is $8 billion in 10 years ago, and it keeps growing by around 10% every year. And that consistency allows it to trade for a PEG ratio of 2, whereas most stocks don't trade at a premium like that. Let's look at their PE ratio over time. You can see that the low end of their PE ratio is around 21, and the high end the high end is around 30 usually. So right now, let's look at the PE ratio is 32 for MasterCard. So if you look at our history, 32, that's like halfway between the average over time. So if you go back to the beginning of time, 10 years ago, you see 32 is about half of where it was in 2000. So it's like it's a fair value. I don't see it as undervalued right now compared to where it was in history, but it's kind of fairly valued. But it's one of my favorite stocks because when we look at this, we see it's growing around 16% if you average these out. And the PE is 32, so the PEG ratio also is around 2. But you can see that these growth rates are in a straight line. And that is super important that we have projections. It's not every stock has a moat like these two stocks have. And because they're going up, consistently, you have to pay a premium for, such a great quality stock. Now, these stocks will sell off. Like in the pandemic, both of these stocks went down a lot, and they'll probably go down to a PEG ratio of 1, in a really bad market. But it isn't until you do these exercises where the stocks will, what they're truly worth and compared to their growth rate. All right. Any questions on that? All right. Let's look at what's going on in the stock market now. Okay, hold on for a second. Okay, let's look at the ETFs. One's doing the best and the worst. Oil is going down. Oil, telecom, energy. These are all stocks. Let's see. The ones doing the best are healthcare. Okay, so we've had almost every day this year, we've had like the tail two markets. We've had the stocks that did good last year, which were very conservative, that pay a dividend, and the stocks that did bad last year, the tech stocks. So the ones so right now there's a very conservative tone to today's market. We have this consumer staples doing good. These are all dividend-paying stocks that are conservative. Healthcare, dividend-paying, consumer staples, gold miners. Let me see. Home builders. Okay. So we're going to have a lot of volatility when the earnings come up. So we have the banking earnings coming out today. So we have a lot of volatility in that sector. I would expect the banks to go down. Here's bank ETF is down like 1%. So, but we do know the tech stocks will have a tailwind from the dollar going down. So I guess every one of the tech stocks that are overseas oriented will have 5 or 10% better report than normal because of the dollar. Let's look at what's going on in Yahoo Finance. Okay, so we're basically flat for today. I think when you look at a flat day like this, you see, let's look at our stochastics. Everyone in the stock market knows we're like running up against this resistance, this long resistance here. So there's no one that's really willing to be buying today because everyone knows we're basically hitting the top of that panel and we're probably going back down here. So I guess we might have a bad earnings report trigger a sell-off, maybe a big tech stock or a big stock that's watched. If it goes down, or if we have a geopolitical event, that'll trigger something to go down, but you have to be ready for that. Let's look at, so right now everything's flatlined. Let's look at some of these stories. Okay, I'm surprised that Tesla keeps coming out with new products. Just when we thought their business was a car manufacturer, they're coming out with new products like robots and now electric quad bike for kids. They have semis, and right now we have another thing to look forward to. Hold on. Tesla, Elon Musk had an interview that said Tesla's going to have a chat GPT moment with full self-driving cars, most likely by next year. I think that's another big product that's coming out, and that could lead to robo-taxis, and it could lead to dominating the self-driving car industry. Other companies might use this technology. And Elon Musk says that his AI is far above everyone else's. So I would trust him whenever he has, an insight on that. And
they're also opening up, I think, things in India as well. But that's a big boost to the sort of stocks that we build up.
Oh yeah. Yeah. So there, not only is Apple exploring, manufacturing in India. Now Tesla is starting to do that. Do you have any more?
Apple is already set. They have already started manufacturing, but Tesla is going to start sometimes at the end of this year. So,
do you have any other insight on Tesla? Why you're an excited shareholder of Tesla, Ashok?
Always solid. Tesla has been saving my ass for the last 2 years. So.
Well, any other like what are you excited about? In
right now, Tesla, because Tesla with the I'll tell you one more thing. With the car prices dropped, Tesla car prices dropped. All these other companies will have huge effect on their sales. I went to California a few weeks ago. Only cars I saw on the roads, most of them were like Tesla. Everybody had Tesla.
Wow.
So I see that their sales are going really high, and I think the earnings is up 27th or something like that.
Mm-hmm.
This is definitely, it's a very bold, it looks really bold.
Yeah. What do you think about the possibility of Tesla taking over the energy market? For instance, I was thinking with this announcement of Tesla having a standard charging for America, they've actually made deals with GM and Ford.
Yep.
And I'm wondering, what do you think the possibility of Tesla being the next ExxonMobil, being the power and the energy for cars of the future and the standard? Do you think there's a big opportunity there or not?
Still a lot to do on that area, but I'll say they are one of the most dominant car companies at this point, But still to take over the whole Americas, the first step. I think it would still take some time.
Yeah. Okay.
It's I think maybe because to put that much of infrastructure, it will still take some time. Not too long, but and I'm not sure what their goal is. They want to take over the whole country, or they want to just make sure they share things with people. What exactly? I'm not sure about that part. But it will to take over, just to become a solid, just to take over the country. The power and it will take time.
Okay. So I noticed that their earnings estimates haven't changed substantially, maybe by a penny or something. I was expecting this to ramp up, if there are some of these products that actually come out and are helping their earnings, but nothing has changed. So we're going to keep our eye on Tesla every time a new story comes out, because it's fascinating to me how that Elon Musk comes up with a new product out of the blue and it becomes maybe something more valuable than his prior products. So, all right, so we'll watch that.
What's the new product that Tesla come out with? The full automatic driving?
No, not that one. I think they also have that quad bike for the kids.
Oh yeah.
They just introduced that.
They
It's
introduced
it's
a
a
new
small
electric.
percentage, but yeah, but still it will, people get excited. Do you know about the short story? What happened with the shorts
No, what happened?
a few years ago when they to make fun of a short seller, he he introduced a short, like a 7 inch or 6 inch shorts, and they were sold out within like 20 minutes. Yes. So Tesla shorts, and then they were sold out in like 20 minutes. Everybody wanted that short. But anyways, continue.
All right, all right, all right. Here we go. All right, so we're gonna keep watching the estimates for Tesla and the products that they're coming out with. I did a follow up with Charles Schwab because banks are coming out with their earnings this week, and there's a good chance with the bad earnings report, maybe Schwab might go down. And I put a small position in this, as a starter position, just because I saw it was growing at 20%, and it went down. It's one of the biggest banks in the country, actually, but it didn't have a lot of the problems that Silicon Valley Bank had and some of the other banks had. And so I saw it as a potential, if it kept, see, right here is when I was looking at it with you a couple weeks ago. And I'm just following up with this. It's just to make sure that if it does go down with the banks this week, we can see that, the earnings estimates and Charles Schwab is the largest brokerage in America right now, and they just bought TD Ameritrade, so they're growing, and right now they're growing at around 20%, and the PE is around 18. So that means their PEG ratio is 0.9, and that means they're 10% undervalued. And for me, it was just with this whole banking crisis, I thought it was an opportunity to start diversifying into the banking world, which is pretty much, it's slower growth, but they pay a dividend, and it is a way to diversify. And I see this as growing at around 20%, and there a lot of the sector is down. The finance sector, bank sector is down with all the Silicon Valley Bank problems. But it's still, kind of reasonably valued right now. And the 4P is 18. Yahoo Finance thinks it's only growing at 9% because its PEG ratio is 2. They have a really good profit margin. Our minimum is 13, and they have 34. And return on equity is okay at 17. So if this stock drops, then we can see that it's, you can get it at a bargain if it does. Let's see. There's another little thing that came up in Twitter. I like to follow people that have interesting comments. This guy said, "You make more in bull markets than you lose in bear markets," and this is a very good example of, the bull markets are in green, the red markets are the bear markets. So you can see that this kind of goes with my theory that I was saying last week about that the stock market is a little different than gambling. The more you have your money in the stocks and in the stock market, the better chance of your success. And a lot of times, like last year, we were right around this time, we were saying we're going into an interest rate sensitive environment where they're starting to raise rates. And we knew that the stock market was going to go down a little bit from that. But you have to look at the big picture that the bull markets are much, you make more in those than you lose in the bear markets. And that's going back, as long as we can look back. So don't let a little blip in the stock market scare you out of your positions. For me, I'm like, I know that if I sell, my positions, I'm going to have to pay 20% capital gains tax. And that just totally messes up my long-term plan to buy and hold and through the majority of these bull markets. So right now we're probably, we only went for 1 year of going down before we started going up again. So that kind of matches this pattern of a couple years of a bull market, maybe a year of a bear market. Okay, there was an article about Alphabet, and the owner of Google stock rises 4% over Google rolls out new guard features, and basically they're showing off some of its new functionality, and I'm sure Google's they bought one of the best AI companies 10 years ago, and they've been investing in this in a long time. So now they're rolling out some of their products, and I thought it'd be good to check in with Google to see what their growth rate is, and this has been one of the most consistent stocks, that are owned throughout all the hedge funds, mutual funds over time, and people buy and hold this. It's very similar to Visa and MasterCard, where their consistent growth rate over time, they've been growing at like 15%, 14%, at least for the past 10 years, and they're projected to grow that much. So right now they're growing around 15%. So if you divide 2023 by 24, these two numbers, you get 15%. And if you divide these two numbers, they're 15%. So they're still growing at 15%. The PEG ratio, their P ratio is 23. So they're about, their PEG ratio is 1.5. So they're 1.5 times overvalued. And if you divide the current price, which is 120 something, by 1.5, you get 83. And that's where it basically traded down to right here at the beginning of this year. So that's why it's important to understand the fair value that really high quality companies like Facebook and Alphabet, if they go down on bad news, you have to watch for that PEG ratio 1, because whenever Facebook went down at a fairly valued 15 PE, that's whenever it basically bottomed, and that's the same thing that happened with Google. So we're going to watch out for that PEG ratio of 1 as the time. If you're not invested in growth stocks, that's the time to start looking about acquiring them. All right, so let's look at some of the other information on Google. We have a PEG ratio of 1.5. That matches what we just came up with. Profit margin is 20, return on equity is 20, and they have a lot of cash too. So that's called a good balance sheet, when you have more cash than you have debts, and you have good profit margins. And I think the only thing that can stop Google right now is legislation and people suing them. So we'll see what happens there, but it's good to go through that article. But they're not going to give up on AI, and I don't think that ChatGPT is something that can overtake their search business at this time. But it's possible. So that's why they're investing in AI too. All right, so let's look more about what's going on in the market movers for today. We have United Health Group. They just came out with earnings, and that was really good. So we've been following United Health for a while now. And basically what happened is, as soon as United Health came out with their earnings, other companies in the same industry, they go up with that in sympathy. So that's why you have a couple other companies. Actually, CVS is another one of those stocks in the same industry, and they're not up. So that's interesting why CVS is going down and these other companies are going up. We have a lot of healthcare. We have Eli Lilly. Tesla's up another 2%. One's going down the most, the banks here, because banks are coming out with their earnings, and I haven't followed these stocks, but they might not have reported earnings that met expectations. I'm not sure. AT&T, this is just, let's look at AT&T. It's down another 4%. It's been going down quite substantially over the past week and month. It's down 4% today. That is a lot for a stock that's already it's yielding at 7% right now. Let's look at the chart on AT&T.
Yeah, what's up with that? That's very unusual.
It's actually it's at the 2022 low. This is an example of support. Whenever there was support in a prior time, a lot of times a stock will trade down to that exact same level. It's like that. That's exactly where it was last October at the lows. So, but it's paying 7%. So the problem with AT&T right now is they have a lot of competition from T-Mobile that's very aggressive with giving away phones and taking their customers away. And Verizon's losing customers, AT&T's losing customers. There's a good chance that AT&T might have to reduce their dividend. If they do, you're going to have a next round of selling. That'll be like really bad if they. I'm not sure. Mark, do you know why AT&T is like in the doldrums here?
No, no.
Okay, I think
But yeah,
I think this.
Yeah, go on.
You're good. Do you have any? Do you have any other dividend
It was
stocks?
downgraded by JP Morgan. That's why it went down.
Oh, they're downgraded by JP Morgan.
Oh, there you go.
Okay, let's look at VZ. Verizon is actually doing bad too.
Well,
That's
10 out of 10 out of 10 analysts recommend buy AT&T.
okay. Well, AT&T they diversified. They sold off their media business and to focus on just on phone service. And now they're having a problem where they're losing business to other telephone companies, and they have to spend on upgrading all their hardware and their lines. So Verizon is doing very, very similar they're in a similar downtrend. And I guess T-Mobile is kind of sideways right now. Let's look at T-Mobile in comparison. And so it's a very, very competitive environment. It's good for Apple because they have to give away iPhone 14s in order to get their customers. Look at that dichotomy. T-Mobile is in purple, and AT&T and Verizon are like going down. So you can see that actually T-Mobile is now the largest provider in America. That's the largest network, the best network. And
I thought AT&T had the most network.
I think Verizon had the best network until T-Mobile bought Sprint. And as soon as T-Mobile bought Sprint, they had more 5G coverage, and I think now T-Mobile has a better network.
Yeah, but it doesn't have the most coverage of AT&T. AT&T owns the most bandwidth.
Yeah, I'm not too sure about bandwidth really and how it's provisioned for these companies, but I guess eventually what the government, the FCC, is going to do is they're going to say, well, it's almost like the Baby Bell breakup. There's only so much a spectrum, and they're going to have to share that eventually.
Well,
So
AT&T been having that for long term, so it's not a new acquiring. So FCC may not say anything. They may not say anything for that decade.
Yeah, that's true. So right now we have three major providers in America, and AT&T's clearly they're doing really bad, and they have AT&T and Verizon. They both have a lot of debt. So whenever you have interest rates high for an extended period of time, and you have companies with debt, and T-Mobile, they're not, they don't have as much debt, so that's why you have like this economy of charts. That's why you have T-Mobile doing really good. And so I put a starter position in T-Mobile like half a year ago, and I'm very much considering bailing out of Verizon just because they're losing the game, and they actually bought they bought TracFone and they bought Straight Talk recently, which allows them to get a little bit more of the money from the low end market, because Straight Talk and TracFone, they charge like $10 a month, they for subpar service, but still they still have a little avenue to make a little bit more money with that. But I don't know, it doesn't look good for these two, AT&T and Verizon. So let's look at some of the other market movers here. We have some oil companies. APA, I think it's oil. I'm not sure. Moderna is like a very volatile stock. Mark, are you still invested in that?
Yeah, I remember when they were almost at 500. Should have sold it then.
The interesting thing about the reason I never invested in Moderna was they have like a very low PE ratio. They have like a P ratio of 3, but they have no forward projections. It's an mRNA. This is the company that made the vaccine for COVID, and they ramped up. They were like, we're going to do two things. We're going to look at that. We're going to look at the statistics. So, and we're going to look at their earnings projections. Their earnings projections weren't that great. They weren't solid. That's because it's based on development of new drugs. Because COVID is the demand for that is going down. And let's look at the PE ratio. PEG ratio 4P. It's not even existing. That's kind of why I was kind of afraid to jump into this. And on top of that, you have let's look at the chart for Moderna. You have the potential of a stock that could revolutionize medicine by what RNA, is it mRNA or something like technology? They're basically trading right where they were right before the pandemic. So, right, here's the pandemic. Okay. So prior to the pandemic, all right, so they're not getting any love right now. Let's look at the earnings projections. This is why I couldn't invest in this, because it didn't have any consistent earnings projections. Let's see if that changed since we looked at it last. I'd be really excited to get into a stock that could easily come up with a solution for a vaccine for a common cold or something like that. And they have the technology to do that, but I just don't see the people following this stock don't have the faith to give them. Look at this, negative. So they're still on an R&D, losing money for the next couple of years. So negative 251. Wow. So they made $20 during the pandemic, and now they're down to negative, might be positive in 4 years. So that's stark contrast to the Visa, MasterCard, Google that we were looking at earlier. It's not in a straight line up. It's basically pretty much unknown for the next couple of years. When you have negative numbers, projected like this, there's a chance that they might go bankrupt or might have to be sold or raise more money or something like that. So that they're under a lot of pressure to get the next drug. So you have to have a lot of confidence in their formulas and how they do that. You see, let's look at so their stock prices. Pretty much, you can see that there's prior support right here, right where they're at right now. So they're probably they'll bounce from where they're at now, but I wouldn't be interested in that because the fundamentals don't match all the things we're looking for. But it used to have a PE of 5, but now it doesn't even have a PE with negative earnings. So that was a good little exercise. I'm glad we did that. But all the banks, you have all these banks, Northern Trust, New York. All the banks go up and down with earnings coming out now. Let me see what else is happening here.
When you say on the bank, you mean on the mid-sized bank, right? On the big bank, they stable.
The big banks did really good today. I mean,
exactly.
they started going up 3 to 5% at the beginning of the day, but I guess the mid-level banks, Northern Trust, these are all like mid-tier. Let me see other ones. Okay, so let's look at the NASDAQ. How about the Dow first? This is where the big companies are. JP Morgan is up a little bit. It was up 3%. They had a really good earnings report. One's going down. Oil. Yeah, we don't get a whole lot from that. Okay, so the thing that all these have in common, they have they're more conservative. They're healthcare oriented, and they pay a large dividend. So that's like pretty much opposite what's been going on from the beginning of the year till now. The tech stocks have been rallying and been doing really good. Now we have more of a everyone knows we're at the top of the momentum, and everyone knows we're overbought. So people are shifting now into something more conservative to pay dividends. So that was a good exercise. Let's look at Eli Lilly is up 3%. AbbVie is up 2%. So these are all okay. Okay, let's look at. Okay, so we're done looking at that. Let's now. Does anyone want to go over a certain stock or a certain? Anyone have a question? Okay, so we're going to do a quick screen on Yahoo. On Fidelity. Yes.
Can you take a look at Disney?
What stock do you want to look at? Disney. Okay, so we have Disney. It's trading at a premium right now. Its PEG ratio is like 2 or 3. Let's look at that. The interesting thing about Disney is they had a dividend before the pandemic. When the pandemic hit, they stopped issuing a dividend. Let's see, their PEG ratio, look at that, it's 0.8. So it's supposedly 20% undervalued. Its PE is 17. Let's look at the earnings projections for this company. So, let's see. So right now we have...
When you say PE 17, I say PE ratio 40.
Oh, it's a PE 40? Well, let's look. Let's look at the Disney. Being kind of slow here. Boy, everything's taking a long time. Okay, so the snapshot is the PE ratio is 40. That's right. So I expect the growth to be 40%, which it isn't. To be, let's look at so its PE is 40. Let's look at the earnings projections. I'm thinking they're growing like 5 or 10% a year. Okay, it's in a straight line. That's a good thing. But it's not very consistent and not great. So right now, the business model for Disney is they make a lot of money with their theme parks and with their programming, like Disney. Right now, they're doing streaming through Disney. They're actually losing money through their Disney Plus offering. So they're trying to transition from a media company like ABC, and they're trying to get rid of those media assets and be more the broadcast TV assets. They just said that this week, and they're trying to move more towards streaming things with higher margins. Let's do a calculation of what they're growing at right now. Right, this is a really big calculator. Hold on. Okay. 353 divided by 3. That's 8% from this year. 3.80 divided by 5.13. That's 25% from this year to next year. 5.13 divided by 6.24. 18% from 24 to 25. Then 9% after that. So it's very inconsistent. It's going up, that's great, but I'd say it's growing 10% on average. For a P of 40, that's 4 times overvalued. So I wouldn't be interested in this because look how inconsistent. It'd have to drop in fourth for me to even look at this. The great thing about Disney is they have franchises that are very valuable, like the Star Wars franchise and the Disney, just the movies, and they have a movie making business and theme parks. But right now they're losing money on their streaming.
Yeah, but that may change, right? Because they have content specialized by them that other streaming service may not have.
Yeah, they're also getting into debt buying. They're actually trying to. They're trying to buy the rest of Hulu from Comcast, and that's going to get them into debt some more. And the more debt that you have, the more, the harder it is for you to grow as a company because you got to pay down on that debt. Let's look at the Disney debt. Hold on. Let's look at the debt. This is the balance sheet. Total cash, $10 billion. Total debt, $48 billion. Okay, that's not that bad. For a company that's $165 billion, but still that's substantial. If they pay more to acquire the this Hulu, that's like half of their market cap. And that's pretty much one reason why that's holding the stock back a little bit. The other things are they have this ESPN that they invested a lot of money in that's starting to lose customers. And Google just got the rights for NFL streaming. So they don't have any of you have to pay a lot of money to get good sports games to watch. And they're not investing in that. It's becoming a losing situation. They're trying to get rid of ESPN and they're trying to get rid of ABC and to pay down some of this debt. So it's like, I don't want to be involved with that because it's so complicated. I'd much rather see a company invest in a company with no debt and doesn't have as much competition. Netflix is really eating their lunch. They're making money, whereas Disney is still putting money into it and it's not profitable, the streaming part of this business. So it just seems like it's 4 times overvalued with a PE of 40 and they're only growing at 10%. Forward PE is 17. Okay, so that's why I'm sorry. So their trailing PE is 40, but their forward PE is 17. That's different. So they're maybe double the value if they're growing at 9 or 10%. They still, if they drop to 50, I would dollar cost a little bit into it.
Cramer, a bullish on Disney.
Who is?
Jim Cramer.
Jim Cramer.
He's very bullish on Disney.
Well, what Jim Cramer says, he likes the CEO. The old CEO from like 5 years ago came back, and he's trying to, they made some bad acquisitions, and he's trying to undo all that and trying to get it back on track. And I guess a catalyst for this company is that they just renewed his contract, so he's there as a CEO for another 2 years. So he might get things back on track, but it's like this is like a steamship. You can't turn around a steamship in a day. It takes a long time to make that turn. And this is very similar to Intel, how the companies has a lot of competition and they have to totally change their business model to adapt to new situations. And so Warren Buffett wouldn't like this because, the business model isn't proven. Warren Buffett likes like Gillette. Gillette has, razors. The guy's going to be using razors 20 years from now, but you can't predict, the media world 5 or 10 years from now, really. And they're changing to streaming and they're not profitable. It's just so many questions. And there's so many things that need to be done to make this profitable, and they don't have a dividend and they have this debt. So for me, it's like, it's not very consistent enough for, it's not like a Warren Buffett like investment for those reasons. Is that what? Are you considering buying this, Joe? And if so, what was your thesis?
Well, the optimum price, the forecast, the estimate price for Disney is over 90. Right now, it's lower. It's undervalued. Depend on how the strike of the actors and writers may impact on it. It may not, but the rumor is always forcing an oversold, right? So where the actual the book price, the forecast price is 90 over. Even Warren Buffett owns a small portion of Disney. A very small portion. He sold some, and Jim Cramer also have a bullish thinking on Disney. So I'm thinking that Disney oversold, kind of.
Yeah. Well, Jim Cramer isn't always right. Jim Cramer.
Right.
You have to really.
But you look at the potential. You look at the potential of Disney stream, right? Disney create content that no other channel have, no other streaming channel have. Right now, it doesn't make money, but it doesn't mean it not have potential. So it copyright all of the content only to Disney Plus and Disney. So that's an advantage of it.
Right. Okay, let's look at what CFRA and Morningstar say. CFRA says basically that they're undervalued by 13%, 14%, 15%.
Exactly.
Okay, so that's a good indication. Let's look at that same thing, PE ratio. Right now their PE is 40. Let's say forward PE is 17. So they're basically the low end of their all-time history. So if the forward PE is 17, that's pretty much as low as they've gotten in the past 10 years. So that's a really good indication. So let's look at the Morningstar. Fair value is 145. So that means they're almost
undervalued.
Half undervalued. So their price to fair value, which is the PEG ratio, is 0.6, according to Morningstar. So they have a certain moat. They have this media empire of movies to choose from. I think they got into some debt in buying. Did they buy Fox? I forget who they bought, but they made a big acquisition that was bad. I forget who it was, and that got them into that debt. But I guess both Morningstar and CFRA says that they're undervalued. Let's look. This is the most important part of this CFRA chart from Merrill Edge. We think Diz can move faster with a refined strategy, cost cutting, and Bob Iger leading the company. The cost reduction plan includes content reduction in the current content spend. So they're reducing their expenses, and with this Bob Iger, he's the CEO. This Jim Cramer really likes Bob Iger. He looked to better harmonize business assets in movies, TV programming, distribution, risks of recession, return to capital. Okay, so basically their thesis for CFRA is the current president that's in there right now is cost cutting, and he's making the necessary decisions to reduce that debt and to switch to a media streaming business.
Yeah. And they also invest heavily on the content, which will generate revenue later.
Yeah, they're actually, according to this, they're reducing the content spend, so they're not. Whereas, let's say Netflix is increasing their spend on content, Disney's reducing that spend, so that could hurt them and people wanting to go to their platform. They're not going to have as many new movies and that, so that's a bad thing. Iger extends his comeback for 2 more years. So yeah, so this past week he got an extension for 2 more years for being a CEO. You see, it doesn't really give a good summary like the other one does. Okay, so basically they're betting their future on streaming. They're buying the rest of Hulu. They have this Disney Plus and ESPN. ESPN is turning out to be something they're going to sell. They just said this. They're going to sell ESPN and they're going to sell ABC, and focus on just the streaming part, because I guess sports rights are very expensive and it's not profitable. So yeah, that's an interesting. For me, it's
and
not.
They invest. They plan to invest 30 billion in content creation in 2023. A little bit less than before, but it's still substantially.
Yeah, the good thing about streaming business is you make the content once, and you have that content for 100 years, and
exactly.
And you have, that's what Netflix did. There's people that are new to Netflix now watching movies that were made 20 years ago, and you can still reuse those, and that's content that you can use for your next new customers. So that's like it's really hard for companies to compete with that, because just think of the Stars channel or whatever. They don't have the ability to buy out a movie studio, get all their rights, and then make it a platform for people to buy. But I guess the big question is what are their customers willing to go into 5 streaming platforms, or are they just going to stick with Netflix only? Because Disney, they undercharge for their product, their streaming Disney Plus.
What I see is Disney offer exclusive content on their streaming service that not provided on Netflix. All of their content not provided on Netflix, and their content creation is almost content investment is almost twice as much as Netflix. 30 billion versus 17.
Yeah. So
I'm not investing on it yet. I'm just looking to invest into it. So I'm just kind of wondering.
It's a very good possibility that this stock could be taken out, because they have a niche. They have some streaming, like Apple. If Apple bought this company, Apple could charge.
I doubt it.
Just think they have.
It's a far-fetched scenario.
But just think of what Apple's business model is. They're trying to move people to services. Like for instance, charge you $1 a month for storage in the iCloud, and then they charge you maybe $10 a month for your Disney subscription or your movie subscription. And if they get that from 2 billion of their users, then that could add up after a while, and it might be worth it. So, but if you have a scale of 2 billion users, and you offer them products that they'll probably buy, just that that makes sense.
Let's just say Disney is too big to digest.
Almost
$200 billion. Whoever invests in them or buy out would got onto debt, heavy leverage.
Yeah,
so
right.
They may not. None of them may acquire
right.
recently.
You're right. Apple, they probably do the due diligence that I'm doing right now and saying, well, it's kind of it's not a
Too big?
it's not a well-oiled machine right now. They're still
No,
figuring
no,
things
it's
out.
not just well oiled or not, because they buy for future content creation and market sale, right? But it's too
Right.
big to digest.
Yeah, it's probably too big. So, so in the meantime, I think Warren Buffett would say this is too inconsistent, and they're still developing their business model. And they need 10 years of the same product that's consistently demanded for someone like Warren Buffett to be interested.
Oh,
And
he has a small portion of it. Warren Buffett actually has small portion of business.
I didn't know that.
Yeah, not recently, but he bought long time ago.
Oh yeah. All right. So I think I've overexceeded my time. Thank you very much for attending, everybody. I hope you have a good weekend, and let me know if I can answer any questions in the meantime.
Thank you, Greg.
Thank you, Greg.
All right. See you next time.